GST, its concept, objectives, features, importance and impact of GST on Indian economy. GST is one indirect tax for the whole nation, which will make India one unified common market. It is a single tax on the supply of goods and services, right from the manufacturer to the consumer. Credits of input taxes paid at each stage will be available in the subsequent stage of value addition, which makes GST essentially a tax only on value addition at each stage. The final consumer will thus bear only the GST charged by the last dealer in the supply chain, with set-off benefits at all the previous stages. Thus, all of them are benefited, including business and industry, central and state governments, and the consumer. I am Sakshi Mandwal and the subject expert of this program is Dr. Devendra Kumar Dhusia. He is serving as a faculty in the Department of Commerce and Business Studies, Jamia Millia Islamia, New Delhi. He has 17 years of teaching and research experience and is having a qualification of MCom, MBA IT and PhD in Internet Advertising. GST for business and industry makes easy compliance, uniformity of tax rates and structures, removal of cascading, improved competitiveness, which reduces the transaction cost of doing business in an easy and effective manner. It is IT-enabled service which makes all taxpayer services easy, such as registrations, returns, payments, etc. would be available to the taxpayers online, which makes compliance easy and transparent. It helps in cross states that would ensure that there is minimal cascading of taxes. This would reduce hidden costs of doing business and also increase gain to manufacturer and exporters subsuming of major central and state taxes in GST. Complete and comprehensive set-off of input goods and services and phasing out of central sales tax CST would reduce the cost of locally manufactured goods and services. The uniformity in tax rates and procedures across the country will also go a long way in reducing the compliance cost. GST has been implemented from July 1, 2017 in India. Concept of GST. Goods and services tax is a comprehensive tax levied on manufacture, sale and consumption of goods and services at a national level, under which no distinction is made between goods and services for levying of tax. It will mostly substitute all indirect taxes levied on goods and services by the central and state governments in India. GST is a tax on goods and services under which every person is liable to pay tax on his output and is entitled to get input tax credit, which is ITC, on the tax paid on its inputs, therefore a tax on value addition only, and ultimately the final consumer shall bear the tax. GST is expected to be a destination-based tax that should replace the current central taxes and duties such as excise duty, service tax, countervailing duty CVD, special additional duty of customs SAD, central charges and cesses, and local state taxes, that is value-added tax VAT, central sales tax CST, Octroi, entry tax, purchase tax, luxury tax, state cesses and surcharges, and entertainment tax other than the tax levied by the local bodies. A well-designed GST in India is expected to simplify and rationalize the current indirect tax regime, eliminate tax cascading and put the Indian economy on high growth trajectory. The proposed GST levy may potentially impact both manufacturing and services sector for the entire value chain of operations, namely procurement, manufacturing, distribution, warehousing, sales and pricing. GST is being introduced in the country after a 13-year-long journey since it was first discussed in the report of the Kelkar Task Force on Indirect Taxes. A brief chronology outlining the major milestones on the proposal for introduction of GST in India is as follows. In 2003, the Kelkar Task Force on Indirect Tax had suggested a comprehensive goods and services tax GST based on VAT principle. A proposal to introduce a national level goods and services tax GST by April 1, 2010 was first mooted in the budget speech for the financial year 2006-2007. Since the proposal involved reform or restructuring of not only indirect taxes levied by the centre but also the states, the responsibility of preparing a design and roadmap for the implementation of GST was assigned to the Empowered Committee of State Finance Ministers (EC). Based on inputs from Government of India and states, the EC released its first discussion paper on goods and services tax in India in November 2009. In order to take the GST related work further, a joint working group consisting of officers from central as well as state government was constituted in September 2009. In order to amend the constitution to enable introduction of GST, the Constitution 115th Amendment Bill was introduced in the Lok Sabha in March 2011. As per the prescribed procedure, the bill was referred to the Standing Committee on Finance of the Parliament for examination and report. Meanwhile, in pursuance of the decision taken in a meeting between the Union Finance Minister and the Empowered Committee of State Finance Ministers on 8 November 2012, a committee on GST design consisting of the officials of the Government of India, state governments and the Empowered Committee was constituted. This committee did a detailed discussion on GST design, including the Constitution 115th Amendment Bill, and submitted its report in January 2013. Based on this report, the EC recommended certain changes in the Constitution Amendment Bill in their meeting at Bhubaneswar in January 2013. The Empowered Committee in the Bhubaneswar meeting also decided to constitute 3 committees of officers to discuss and report on various aspects of GST as follows: Committee on Place of Supply, Rules and Revenue, Neutral Rates; Committee on Dual Control, Threshold and Exemptions; Committee on IGST and GST on Imports. The Parliamentary Standing Committee submitted its report in August 2013 to the Lok Sabha. The recommendations of the Empowered Committee and the recommendations of the Parliamentary Standing Committee were examined in the Ministry in consultation with the Legislative Department. The final draft Constitutional Amendment Bill incorporating the above stated changes were sent to the Empowered Committee for consideration in September 2013. The EC once again made certain recommendations on the bill after its meeting in Shillong in November 2013. Certain recommendations of the Empowered Committee were incorporated in the draft Constitution 115th Amendment Bill. The revised draft was sent for consideration of the Empowered Committee in March 2014. The 115th Constitutional Amendment Bill 2011 for the introduction of GST, introduced in the Lok Sabha in March 2011, lapsed with the dissolution of the 15th Lok Sabha. In June 2014, the draft Constitution Amendment Bill was sent to the Empowered Committee after approval of the new government. Based on a broad consensus reached with the Empowered Committee on the contours of the bill, the Cabinet on 17 December 2014 approved the proposal for introduction of a bill in the Parliament for amending the Constitution of India to facilitate the introduction of goods and services tax in the country. The bill was introduced in the Lok Sabha on 19 December 2014 and was passed by Lok Sabha on 6 May 2015. It was then referred to the Select Committee of Rajya Sabha, which submitted its report on 22nd July 2015. One of the main objectives of goods and services tax would be to eliminate the double taxation, that is, cascading effects of taxes on production and distribution cost of goods and services. The exclusion of cascading effects, that is, tax on tax, till the level of final consumers will significantly improve the competitiveness of original goods and services in market, which leads to beneficial impact to the GDP growth of the country. Introduction of GST to replace the existing multiple tax structures of centre and states taxes is not only desirable but imperative. Integration of various taxes into a GST system would make it possible to give full credit for inputs taxes collected. GST, being a destination-based consumption tax, is based on VAT principle. All transactions and processes carried out only through electronic mode, non-intrusive administration. Registration is PAN-based. Registration only if turnover is more than Rs 20 lakh. There is an option of voluntary registration. Deemed registration in 3 working days. Input tax credit available on taxes paid on all procurements except few specified items. Credit available to recipient only if the invoice is matched. Helps fight huge evasion of taxes. Set of auto-populated monthly returns and annual return. Composition taxpayers are required to file quarterly returns. There is automatic generation of returns. GST practitioners for assisting in filing of returns. GSTN and GST Suvidha providers, GSPs, to provide technology-based assistance. Tax can be deposited by internet banking, NEFT, RTGS, debit or credit card, and over the counter. Concept of TDS for certain specified categories. Concept of TCS for e-commerce companies. Refund to be granted within 60 days. Provisional release of 90% refund to exporters within 7 days. Interest is payable if refund not sanctioned in time. Refund to be directly credited to bank accounts. Comprehensive transitional provisions for smooth transition of existing taxpayers to GST regime. There are special procedures for job work. There is a system of GST, compliance rating, anti-profiteering provision. Currently, the Indian tax structure is divided into two: direct and indirect taxes. Direct taxes are levied where the liability cannot be passed on to someone else. An example of this is income tax, where you can earn the income and you alone are liable to pay the tax on it. In the case of indirect tax, the liability of the tax can be passed on to someone else. This means that when the shopkeeper must pay VAT on his sale, he can pass on the liability to the customer. So, in effect, the customer pays the price of the item as well as the VAT on it, so the shopkeeper can deposit the VAT to the government. This means that the customer must pay not just the price of the product, but he also pays the tax liability, and therefore he has a higher outlay when he buys an item. This happens because the shopkeeper has paid a tax when he bought the item from the wholesaler. To recover that amount as well as to make up for the VAT he must pay to the government, he passes the liability to the customer, who has to pay the additional amount. There is currently no other way for the shopkeeper to recover whatever he pays from his own pocket during transactions, and therefore he has no choice but to pass on the liability to the customer. Goods and services tax will address this issue after it is implemented. It has a system of input tax credit which will allow sellers to claim the tax already paid, so that the final liability on the end consumer is decreased. The major features of the proposed payment procedures under GST are as follows: electronic payment process, no generation of paper at any stage; single point interface for challan generation, GSTN; ease of payment. Payment can be made through online banking, credit card, debit card, NEFT, RTGS, and through cheque or cash at the bank. Common challan form with auto-population features. Use of single challan and single payment instrument. Common set of authorized banks. Common accounting codes. A nationwide tax reform cannot function without strict guidelines and provision. The GST Council has devised a foolproof method of implementing this new tax regime by dividing it into three categories. When goods and services tax is implemented, there will be three kinds of applicable goods and services tax. CGST, Central Government Goods and Services Tax, where the revenue will be collected by the central government. SGST, State Government Goods and Services Tax, where the revenue will be collected by the state governments for intra-state sales. IGST, Interstate Goods and Services Tax, where the revenue will be collected by the central government for interstate sales. In most cases, the tax structure under the new regime will be as follows: transactions, old regime, new regime, explanation. Sale within the state, VAT plus central excise or service tax, CGST plus SGST. Revenue will now be shared between the centre and the state. Sale to another state, central sales plus excise or service tax. IGST, there will be only one type of tax, central, now in case of interstate sale. The benefits of GST can be summarized as: for business and industry, easy compliance. A robust and comprehensive IT system would be the foundation of the GST regime in India. Therefore, all taxpayer services such as registrations, returns, payments, etc. would be available to the taxpayers online, which would make compliance easy and transparent. Uniformity of tax rates and structures. GST will ensure that indirect tax rates and structures are common across the country, thereby increasing certainty and ease of doing business. In other words, GST would make doing business in the country tax neutral, irrespective of the choice of place of doing business. Removal of cascading. A system of seamless tax credits throughout the value chain and across boundaries of states would ensure that there is minimal cascading of taxes. This would reduce hidden costs of doing business. Improved competitiveness. Reduction in transaction costs of doing business would eventually lead to an improved competitiveness for the trade and industry. Gain to manufacturers and exporters. The subsuming of major central and state taxes and GST, complete and comprehensive set-off of input goods and services and phasing out of central sales tax would reduce the cost of locally manufactured goods and services. This will increase the competitiveness of Indian goods and services in the international market and give boost to Indian exports. The uniformity in tax rates and procedures across the country will also go a long way in reducing the compliance cost. For central and state governments, simple and easy to administer. Multiple indirect taxes at the central and state levels are being replaced by GST. Backed with a robust end-to-end IT system, GST would be simpler and easier to administer than all other indirect taxes of the center and state levied so far. Better controls on leakage. GST will result in better tax compliance due to a robust IT infrastructure. Due to the seamless transfer of input tax credit from one stage to another in the chain of value addition, there is an inbuilt mechanism in the design of GST that would incentivize tax compliance by traders. Higher revenue efficiency. GST is expected to decrease the cost of collection of tax revenues of the three governments and will therefore lead to higher revenue efficiency. For the consumer, single and transparent tax proportionate to the value of goods and services. Due to multiple indirect taxes being levied by the center and state, with incomplete or no input tax credits available at progressive stages of value addition, the cost of most goods and services in the country today are laden with many hidden taxes. Under GST, there would be only one tax from the manufacturer to the consumer, leading to transparency of taxes paid to the final consumer. Relief in overall tax burden. Because of efficiency gains and prevention of leakages, the overall tax burden on most commodities will come down, which will benefit consumers. Percentage of commodities falling under the specific tax rate. Explanation of above pie diagram is as follows. GST rates on goods, commodities, GST rate. Essential farm-produced mass consumption items like milk, cereals, fruits, vegetables, jaggery, gur, food grains, rice and wheat, nil. Common uses and mass consumption food items such as spices, tea, coffee, sugar, vegetable, mustard oil, newsprint, coal and Indian sweets, nil. Silk and jute fiber, nil. Gold, silver and processed diamonds, 3%. Railway freight, 5%. Pharma, life-saving drugs, 5%. Footwear up to Rs 500, 5%. Cotton and natural fiber, 5%. Packaged foods like pickles, tomato sauce, mustard sauce and fruit preserves, 12%. Ayurvedic and homeopathy medicines, 12%. Processed foods, 12%. Ready-made garments, 12%. Computer printers, 18%. Footwear above Rs 500, 18%. Fruit juices, live animals, meat, butter and cheese, 12%. Mobile phones, 12%. All FMCG goods like hair oil, soaps, toothpaste and shampoos, chemical and industrial use intermediaries, 18%. LPG stoves, military weapons, electronic toys, 18%. Pastries, cakes, pasta, ice cream, soups, 18%. Man-made fiber and yarn, 18%. White and brown goods like TV, refrigerator, AC, washing machines, microwave ovens, soft drinks and aerated beverages, 28%. Cement, 28%. Perfume, revolver, pistols, 28%. Chocolates, chewing gums, waffles containing chocolate, 28%. Luxury and demerits, goods and sin category items, example, tobacco, pan masala, 28% plus cess. Small cars, petrol driven, 28% plus 1% cess. Small cars, diesel driven, 28% plus 5% cess. Cigarettes, 28% plus 5% cess. Luxury cars, 28% plus 15% cess. Heavy bikes, luxury yachts, private jets, 31%. GST rates for services, GST rate. Sleeper, metro tickets and seasonal passes nil. Outsourcing in industries such as gems and jewelry textiles 5%. Railways like AC 5%. Restaurants with annual turnover less than Rs 50 lakh 5%. Cab aggregators like Ola, Uber 5%. Hotel with tariff rates between 1,000 and 2,500 12%. Non-AC restaurants without liquor license 12%. Real estate work contracts 12%. State-run lotteries 12%. Airlines business class 18%. Telecom financial services 18%. Hotel room tariff Rs 2,500 to 7,500 18%. Hotel room tariff above Rs 7,500 28%. AC restaurants with liquor license 18%. Movie tickets below Rs 100 18%. Movie tickets above Rs 100 28%. 5-star hotels 28%. State authorized lotteries 28%. With the proposed implementation of GST from 1st of July 2017 gaining intensity, it is critical for industry to understand the broad contours and framework of the proposed GST law, likely to impact the new levy on the business, take appropriate steps to undertake necessary changes in business processes, assess financial impact, frame pricing strategy, align internal organization and IT systems, and be GST ready. Reduces tax burden on producers and foster growth through more production. This double taxation prevents manufacturers from producing to their optimum capacity and retards growth. GST would take care of this problem by providing tax credit to the manufacturer. Various tax barriers such as checkposts and toll plazas lead to a lot of wastage for perishable items being transported, a loss that translated into major costs through higher need of buffer stocks and warehousing costs as well. A single taxation system could eliminate this roadblock for them. A single taxation on producer would also translate into a lower final selling price for the consumer. Also, there will be more transparency in the system as the customers would know exactly how much taxes they are being charged and on what basis. GST would add to government revenues by widening the tax base. GST provides credits for the taxes paid by producers earlier in the goods or services chain. This would encourage these producers to buy raw material from different registered dealers and would bring in more and more vendors and suppliers under the purview of taxation. GST also removes the custom duties applicable on exports. Our competitiveness in foreign markets would increase on account of lower cost of transaction. The proposed GST regime will subsume most central and state level taxes, is expected to have a single unified list of concessions or exemptions as against the current mammoth exemptions and concessions available across goods and services. Proposed GST rate is higher than VAT. The rate of GST is proposed to be higher than the current VAT rate in India, which, although reducing the price in the longer run, will be of no help in cutting down the prices of commodities. Dual control. A business will be indirectly controlled by both the centre and state in all tax-related matters. The state will lose autonomy to change the tax rate, which will be regulated by the GST Council. Certain sectors will face a negative impact. Sectors that are currently enjoying no excise duty or have enjoyed a lot of tax benefits will have to bear the brunt of a higher tax. These include textile, dairy products, media, pharmaceuticals, IT, ITES and telecom. The same goes for products. It is supposed that the prices of the following commodities will increase: credit cards, mobile phones and jewelry. Loss incurred by the manufacturing states. Since GST is mostly related to the manufacturing segment, most manufacturing states may incur losses, but the government has proposed to compensate for those losses for a period of 5 years. Presently, there are around 160 countries that have implemented GST or VAT in some form or other. In some countries, VAT is the substitute for GST, but conceptually, it is a destination-based tax levied on consumption of goods and services. France was the first to introduce GST. Only Canada has dual GST model, just like India is going to implement dual GST model. Rate of GST ranges between 15 to 20%, generally may differ to higher or lower side in a few countries. Australia 10%, Austria 20%, Belgium 21%, Canada 5%, Denmark 25%, France 20%, Germany 19%, Hungary 27%, Indonesia 10%, Israel 17%, Italy 22%, Kenya 16%, Malaysia 6%, Mauritius 15%, Mexico 16%, Netherlands 21%, Portugal 23%, Singapore 7%, South Africa 14%, South Korea 10%, Spain 21%, Sweden 25%, Switzerland 8%, UK 20%. Similar to Indian context, it is only Canada that has the concept of dual GST. While there was strong rebel at the time of introduction of GST by the then political division in Canada, however, GST sustained despite the opposition. While some others have had to increase the rates very soon after introduction, another aspect encountered and accepted by most of the GST countries lies in the statistics that GST will be inflationary, especially if the effective tax rate is higher than what prevailed before. For instance, Singapore saw a spike in inflation in 1994 when it introduced the GST. That makes it all the more important for administrators to keep tabs on how prices move after imposition of the tax. Another key refresh from Malaysia learning is that businesses need to start early with the implementation processes to be GST ready. The Malaysian government received strong resentment even after providing 1.5 years for GST preparedness. One constructive learning that did come handy in the GST preparation in Malaysia was the release of sector-specific guidance papers on tax treatment concerning each business sector. It aided in addressing the to-be tax practice associated with a particular business segment. Indian legislative bodies could look into similar publications to effectuate the implementation of GST in a smooth way. That is all that we had for you for today. We hope you enjoyed the session. See you again. Till then, thank you and namaskar.